So there I was, sitting at my kitchen table on a Tuesday night, laptop open, trying to do something as simple as check my bank statement. I log in, and before I can see anything, this little box pops up right in the middle of the screen. It says something like, "Help us keep your profile accurate by updating your annual income." There's a friendly little field with a number already in it, and a big green button inviting me to confirm or update. Very clean. Very official looking. Very hard to ignore. I almost filled it out. I had my hand on the keyboard and everything. But something made me stop. It wasn't anything dramatic. It was just a quiet little feeling in the back of my mind. Why does my bank need to know this right now? I didn't ask for anything. I didn't apply for a new product. I'm just here to look at my statement. So why is this the first thing I see when I log in? I close the box without filling anything out. And then I spent the next 2 weeks going down a rabbit hole trying to understand exactly what banks do with that number. What I found genuinely surprised me. Not in a paranoid, conspiracy theory kind of way. More in a this is completely legal, totally standard practice, and almost nobody talks about it kind of way. And by the time I'm done here, I think you'll feel the same way I do. That little income field? It's not there for your benefit. Not even a little bit. Let me start with the thing that bothered me most when I first learned it. Banks are not required to ask for your income in most everyday situations. There's no federal law that says your credit card company needs to know your salary. There's no regulation that requires your bank to have a current, updated income figure sitting in your file. They ask because they want to know. They ask because that information is genuinely valuable to them. And the difference between something being legally required and something being something a company wants from you is enormous. One you have to do. The other you have a choice about. Banks have spent a long time blurring that line because customers who understand the difference tend to make decisions that cost banks money. Think about how normalized this has become. You apply for a credit card and the application asks for your annual income right between your address and your social security number. It feels like standard information. It feels like part of the process. Nobody questions it because everyone does it and it's been this way your whole adult life. But just because something is routine doesn't mean it's neutral. That income number the moment you submit it gets pulled into systems you will never see, running calculations you will never know about, producing a profile that shapes how that institution treats you going forward. Not just whether you get approved. Everything after that too. Here's what I mean. There are 4 specific ways banks use your income data. And none of them are really about making your life easier. The first one is credit limits. This one seems the most straightforward and that's exactly why it's the easiest to misunderstand. Banks use your reported income to decide how much credit to extend to you. Higher income, higher limit. Simple enough on the surface. And sure, there's a logic to it. Someone earning more money can theoretically manage more credit. But here's the part the bank doesn't advertise. Higher credit limits aren't given to you as a reward. They're given to you as an opportunity. An opportunity for you to spend more, carry a larger balance, and pay more interest over time. Banks have done the research on this. Customers with higher limits tend to use more of them. Not because they're irresponsible. Just because the availability shapes behavior. A $25,000 credit limit changes how you think about purchases in ways that a $6,000 limit doesn't. The bank knows this. The higher limit isn't generosity. It's strategy. And your income figure is what unlocks it. The second way is interest rate targeting. This is the one that really got under my skin when I first understood it. You would assume that if you earn more money, you represent less risk, and therefore you'd get better interest rates. And sometimes that's true. But not always, and here's why. Banks don't just think about risk when they set your rate. They think about price sensitivity. They think about how likely you are to notice a higher rate, care about it, and do something about it. Someone earning a comfortable income might not scrutinize their APR closely. They might not bother calling to negotiate. They might not shop around for a better offer because the hassle doesn't feel worth it at their income level. The bank's algorithm picks up on signals like this. It factors in income, spending behavior, account history, and a bunch of other variables to figure out not just what rate you qualify for, but what rate you'll actually tolerate. There's a term used in the industry for this. Ability to pay pricing. The more you can afford, the more some institutions will charge you, not because you're a riskier customer, but because they've calculated that you'll absorb it without pushing back. Your higher income can literally result in you getting a worse deal than someone earning less. That's not a mistake in the system. That's the system working exactly as designed. The third way is marketing and upselling. The moment your income gets updated in the bank system, you get recategorized. That recategorization determines what offers you'll see, what products get pitched to you, and how aggressively the bank pursues your wallet going forward. High earners get targeted with premium cards carrying annual fees in the hundreds of dollars. They get pitched on personal loans, wealth management introductions, travel insurance bundles, and all kinds of financial products that carry healthy margins for the bank. The targeting isn't random. It's calibrated to your income bracket with a level of precision most people would find uncomfortable if they knew about it. Lower income customers face a different version of the same problem. Fewer premium pitches, but more aggressive offers around balance transfers, high-interest personal loans, and credit limit increases specifically designed to pull them deeper into debt. Different income, different trap. Same underlying logic. Your income data is an instruction manual for how to separate you from more of your money. The fourth way income data gets used is something most people never think about at all. It's what happens during economic downturns. When the economy gets shaky, banks quietly review their portfolios and make decisions about which customers they want to keep and which customers they want to reduce exposure to. Credit limits get cut. Interest rates get bumped. Some accounts get closed entirely. These decisions run on algorithms, and income data is a major input.
A customer who reported high income might have their credit limit preserved because the algorithm projects continued repayment capacity. Or that same high income might flag them for rate increases because ability to pay pricing logic says they'll accept worse terms without leaving. A customer who reported lower income might see preemptive limit reductions because the algorithm treats them as higher risk in uncertain times regardless of their actual payment track record. The only thing that breaks you out of this sorting process is having less income data in the system. The less they know, the more they have to go off of your actual behavior. And your actual behavior, if you pay on time and keep your utilization low, is a much more honest and favorable picture than whatever income bracket the algorithm has filed you under. Now here's something that took me a while to fully appreciate. Income data doesn't just sit in a file and slowly fade. It persists. It gets used, reused, shared with affiliate partners, and factored into decisions years after you first entered it. That number you put on a credit card application 4 years ago might still be shaping how you're treated today. Most people assume their old income information becomes irrelevant once they've been a customer for a while. That assumption is wrong. Banks have long institutional memories. Your financial profile is a living document that gets updated and referenced continuously. And here's the kicker. Banks don't value old data the same way they value fresh data. Stale income information is less predictive, less useful for the algorithm, which is exactly why they keep asking you to update it. Every time you comply and enter a new number, you essentially reset the clock. You become freshly categorized. The algorithm lights up and starts running new calculations. New offers get queued. New decisions get made about your account. You just handed them exactly what they needed to optimize against you again. Did I want to tell you about something that happened to someone I know because it made all of this very concrete for me. My friend Marcus works in software consulting. His income fluctuates pretty significantly depending on the contracts he is running at any given time. When he first applied for his main credit card, he was between big projects and reported an income that was on the lower end of what he typically earns. He got approved, got a reasonable limit, and honestly had a pretty quiet and unremarkable relationship with that card for a couple of years. Then he landed a major contract, and at the same time, his bank sent him an offer for a credit limit increase. To process the increase, they asked him to update his income. He was in a good mood, the contract was going well, so he entered his current earnings, which were substantially higher than what he'd originally reported. Within about 6 weeks, everything changed. His inbox started filling up with offers for premium travel cards with $400 annual fees. He started getting calls from the bank's personal loan division. His credit card app suddenly had banner ads for investment products every time he logged in. He got added to some kind of outreach list that had someone calling him once a week about wealth management services. Marcus told me it felt like he'd accidentally walked into the VIP section of the wrong kind of club. Everyone was very eager to help him in ways that would cost him a lot of money. He hadn't changed anything about how he used his credit card. He paid on time every month. His utilization was fine. The only thing that changed was the number he'd entered in that income field. And that one number had completely changed how the bank saw him and treated him. He stopped updating his income after that. Every pop-up got closed immediately. It took about 5 or 6 months, but the aggressive marketing gradually wound down. The calls slowed, the offers became generic again, and his banking relationship returned to the quiet, unremarkable state he actually preferred. What Marcus discovered by accident is something worth understanding intentionally. Banks optimize for fresh data. When they have current, accurate income information, they know exactly which box to put you in. When they're working with old data, their models get less precise. They default to treating you more generically, which often means more conservatively, which usually means fewer aggressive upsells and more stable account terms. Your outdated income figure isn't the liability. In a lot of cases, it's a form of protection. I want to be very direct about something before we go further because I think it's important. Nothing I'm saying here is an argument for lying. Providing false income information on a credit application is fraud. It's illegal. It's genuinely harmful, and it's wrong. Don't do it. What I'm talking about is something completely different. There's a meaningful difference between lying and simply not volunteering information that isn't required. When a bank you've been a customer of for 3 years sends you a pop-up asking you to update your income, you are under zero legal obligation to respond to that pop-up. You can close it. You can ignore it. You can close it every single time it comes back. That isn't deception. That's privacy. That's you choosing not to hand over information that will be used to make decisions about your financial life in ways that benefit the bank, not you to SO. When are you actually required to disclose your income? Mortgage applications are the big one. Federal regulations require lenders to verify your ability to repay under qualified mortgage rules. You will provide pay stubs, tax returns, employment verification, and possibly more. There's no getting around this, and honestly, you wouldn't want to. The income verification requirements for mortgages exist because the absence of those requirements is literally what contributed to the 2008 financial collapse. Auto loans typically require some income disclosure, though the level of verification varies a lot depending on the lender and the loan amount. Some lenders do thorough verification. Others are more lenient. Credit card applications ask for income, and here's the thing most people don't realize. Credit card companies almost never actually verify the income you report. They don't have access to your tax returns. They can't pull your pay stubs without your permission. They are essentially taking your word for it, which raises an interesting question. If a bank wants your income badly enough to put it right there on the application, why don't they bother to verify it? The answer is that the precision of the number matters, less than having a number to plug into their algorithms. Even an approximate figure is enough to categorize you. And all those periodic update requests you get once you're already a customer? Those are entirely optional. The bank wants that information.
They don't need it. There is a difference. I've been thinking about this a lot, and what it really comes down to is a fundamental imbalance in how information flows in your relationship with a bank. The bank knows an enormous amount about you. They can see every transaction you make on their products. They know your spending patterns, your payment timing, how close to your limit you run, whether you pay in full or carry a balance, and which categories you spend the most in. They feed all of that into sophisticated systems that are specifically designed to maximize what they earn from your relationship. You, meanwhile, know almost nothing about their internal process. You don't see the algorithms. You don't know what factors into the interest rate you were offered. You don't know whether your file has been flagged for marketing, for rate review, or for anything else. You make decisions in the dark while they make decisions in the light. When you decline to update your income, you're not evening the playing field. The imbalance is too large for that. But you are narrowing the gap slightly. You are giving them one less tool to use. And in a relationship this asymmetric, that matters. So what should you actually do with all of this going forward? Let me be as specific as I can. When you apply for a new credit card, you're going to need to provide income information because it's part of the application process. You can't really skip it. But be thoughtful about what you report. If your income is variable, you don't have to use your highest earning period as the baseline. If your income comes from multiple sources, you don't have to include every stream. Report honestly within those parameters, but don't volunteer more than you need to. There's a meaningful difference between providing accurate income information and maximizing the number you enter to increase your approval odds or credit limit. When you see an income update pop up on an existing account, close it. That's it. Just close it. You will not be penalized. Your account will not be affected. Your credit score will not change. The bank will ask again in a few months. Close that one too. You can do this indefinitely and nothing bad will happen. The pop-up is designed to look important. It isn't. It's a data collection request dressed up as a customer service notification. When a bank offers you a credit limit increase that requires income verification, stop and ask yourself whether you actually want the higher limit before you decide how to respond. If you genuinely want more credit capacity, then providing the information might serve your interest. But a lot of people reflexively say yes to higher limits without considering whether they need them or whether the trade-off of handing over fresh income data is worth it. If your current limit is fine for your needs, you can decline the increase and keep your income information to yourself. When you apply for a loan and income verification is required, provide what's required and nothing more. If a lender asks for documentation beyond what's standard for the loan type you're applying for, it's completely reasonable to ask why before handing it over. When you get a phone call from your bank asking you to update your financial information, remember that the phone is designed to create a sense of urgency and authority that makes non-compliance feel awkward. You can simply say you're not interested in providing that information and end the call. Your accounts will remain open. The calls will eventually stop. You don't owe anyone an explanation. The bigger principle underneath all of this goes beyond banking. Every institution that collects your data is collecting it for their own benefit, even when they frame it as being for yours. Help us serve you better. Keep your profile accurate. Ensure you have access to the best offers. These phrases all mean the same thing. Give us more information so we can more precisely extract value from our relationship with you. That's not cynical. That's just honest about how data-driven businesses operate. Providing what's required and being deliberate about what's optional isn't paranoia. It's just paying attention to the actual dynamics of the relationship. I want to be fair here too. Banks aren't the villain in some simple story. They provide services that genuinely matter. Credit cards are useful. Loans enable things that would otherwise be out of reach. Deposit accounts keep your money safe. The financial system, for all its flaws, functions and most of us benefit from it every day. But banks are also businesses with shareholders and profit targets, and customer data is one of the primary raw materials they use to hit those targets. Holding that truth alongside the real value they provide is not contradictory. It's just accurate. You can appreciate the services and still be clear-eyed about the mechanics. So the next time you log into your bank account to do something simple and that familiar little pop-up appears asking you to keep your profile up to date, you'll know exactly what's actually being asked. You'll know it's not about serving you better. You'll know it's about feeding an algorithm that will use that number to figure out how to make more money from you. You'll know that you have a choice. And you'll know what to do with that choice. Close the box. Let your payment history speak for itself. That's the data that actually reflects who you are as a customer. And unlike your income, they can't get it just by asking.